Hello, folks. It's a wonderful Friday. The weather's getting beautiful. And this episode, we're going to finish off the three-part series about how to read your financial statements. We did the profit and loss, the balance sheet. Now, today, we're going to do the cash flow. We have the wonderful Stacey Bennett today, and she has her own company, does accounting, and really is such a great soul and power in the world of adding more value to businesses than just accounting. And I love to see it. And she's doing other shows, and I'm appreciative of her to spend time with me and you guys to lay it out for us how everything works in the financial statements. Of like I've said before, this doesn't answer all the questions, but it certainly gets us down a path of learning more about it and understanding it better and getting more comfortable with it, because it's the awareness and the comfort that's important. So um, I appreciate you, Stacey, a lot. And she gave me a bit of a hard time on the start of this one because I had stuff in my teeth. And anyway, we did a second cut, and it's all good. And I'm thankful that somebody will call me out on my crap. So thank you, Stacey. And I hope everybody enjoys. I hope you come away with something. And of course, at the end of this, and now we want to do a Q&A. And if anybody has any questions, we want to do a live um, question and answer. So if that interests you, please, comment in here, or reach out to me, and we'll put that together for everybody to help them with their financials. No charge. Obviously, our time is limited, but we will do as much as we can within maybe an hour or two. So happy to collaborate on that with everybody, and I hope you enjoy the episode. I know I did. Bye.
Greg Sheldon here, your host of Metal, Steel, Manufacturing, and Business Pro podcast, where you learn everything about the metals and manufacturing industry that make your modern day life possible.
All right, so we're back, everybody, with Stacey Bennett, and thank you for coming. She's forced me into doing another cut here, and that's okay, because she's in control, because she knows more about this stuff than I do. So we did a profit and loss the first time, and then we did a balance sheet video. We did those two, and I think there was a lot that I learned more so about balance sheet, because profit and loss is somewhat simple, right? So can we do just a bit of a recap from the P&L to the balance sheet, and then how today integrates to both of those? Is that
Yeah,
a good way to go?
sure.
Okay.
So yeah, we talked about in the last two segments the profit and loss balance, or the profit and loss / the income statement of operations. That statement is intended to show you what your income from sales and operating activities is, excluding any sort of influx of cash that comes from loans or owner's equity, like cash infusions, right? It entirely focuses on operating income and then operating outflow. So that's the profit and loss statement. The balance sheet, on the other hand, shows what the balances of all of your different asset and liability accounts, as well as any movement in and out of those accounts throughout the period, and then ending with your owner's equity in the company, right? So that's the equity that you've accumulated over time in the form of profits, less any debts that you've taken out and all of that, right? So you've got over here, you've got your operating statement, and you've got over here sort of like your value and balances statement. The downfall to those two, or maybe the missing element in those, is what happens on where does the money that moves in and out of your company that is not captured on your P&L actually show up, right? So again, the P&L isn't going to touch on loan proceeds. It's not going to touch on money that comes into or goes out the business in the form of owner draws or owner contributions, right? And so a lot of times business owners end up with this question, well, I sold $60,000 last month and I only spent $40,000 of it. Why do I only have $100 in my account? Right? Like that doesn't add up. And the reason it doesn't add up is because there's other cash movement that happens in your business that's not operating activities. So the cash flow statement is intended to kind of bridge that gap. And it's there to tell you, in addition to all of the cash activities that happen from operating, from sales and paying expenses and paying employees and contractors, outside of all of that, what other cash movement is happening that gives you what your ending bank balance is? So that's what we're going to talk about today, is how to understand what I call the bridge. The cash flow statement is the bridge between your balance sheet and your income statement. And you'll see that when we get into some of the illustrations.
Okay. That helps a lot. Okay. I've got some questions, but I think if we just move forward, then it'll be easier to ask it while we're going.
Sure. So I'm going to share. Oh, can you enable some screen sharing? And I will make this a little bit more tangible.
Yeah. We good?
Yep.
All right.
All right. So you should see an income statement here.
Yeah.
So again, the profit and loss, the income statement is going to show you the money that you've collected from sales and revenue, minus the money that you've spent on actual business expenses, any additional sort of other income or other expense types. So you can see here like interest income, credit card rewards, things like that would show up here. So this is like the net taxable income that you've got at the end of the period.
Okay. Right.
Your balance sheet is again going to show you and this is, if you watch the balance sheet video, you saw what we talked about is the variance report. So this one is run to show the current period that we're looking at compared to the end of the last period and the dollar change over time, right? So here we see, we ended the period with 1907 in cash assets. We had an increase of 3641 in our liabilities on our credit card. And then we've got our current year ownings and then our different types of draws, right? So that's the balance sheet.
Okay.
When we get into the cash flow statement, this is sort of a hybrid of the two. So we've got in the operating activities, this is essentially a summarized P&L or a summarized income statement. The financing activities is sort of like a summarized balance sheet. And then the cash and cash equivalents give you the piece of information that connects those two dots.
So when is it summarized? Like when you print it, or?
Yes, you could run this report I ran this out of Xero, and all accounting softwares have some form of the cash flow statement, and they look different, right? So some cash flow statements will show financing and investing activities broken out differently so that you can see the difference between like debt and liability changes versus like equity changes. The statement of cash flows in Xero combines the liabilities and equity into this financing activities. So I'm going to show you on the next page kind of where everything comes from and how it populates.
Okay.
But the thing to know kind of like in this brief is like you've got your income statement here, your balance sheet here, and then everything comes together here.
Okay.
So popping over, let me get back up to the top here. All right. So what do I say when I say that this top of the statement of cash flows is the income statement? So if you look at these numbers, we have our sales. That's our receipts from customers, that top line of the cash flow statement, right? Our receipts from customers. Then we've got our net other income, other expense, right? So this 571.67 shows up cash receipts from other operating activities. And then if we go to the next slide, our total operating expenses also from our income statement shows up here in the middle, which is going to leave us with this 3773 in the net income for the period as the net cash flows from operating activities.
Okay.
right? So again, if we're looking back at the statement of cash flows, we've got our total sales from customers, our total expenses from the P&L, our total other income and expenses, and our net income or a net profit. So this is the income statement on the statement of cash flows.
Okay.
Any questions on that part?
Well, I'm just curious, why would somebody want to look at the cash flows versus the income statement? I mean, other than verifying things are true, what would be the reason?
Give me just 1 second. I am so sorry.
That's okay, no worries.
So why would someone want to look at the statement of cash flows versus just some of these other reports by themselves? In isolation, the profit and loss doesn't give you a picture of what your actual cash flow in your business looks like, right? If you look at your income statement and you see that you have a net income of $20,000, that may leave you with an inaccurate picture of what's actually going on in your bank account. Let's say you've also got a $7,000 monthly draw that you take as an owner, and you've got about $6,000 in recurring monthly debts that you need to pay towards. That's $13,000 of that 20K in profit that is unaccounted for. And so if you as the business owner are trying to make choices about, can I afford this new expense? And all you have is the profit and loss statement, it can lead you to making decisions that are ultimately going to be what puts you under. I cannot tell you how many times I've worked with a client and they're on the books profitable and on the verge of bankruptcy.
Oh my
And that
gosh, yeah.
happens because all of these other outflows are not captured on the P&L. So we really want to know both. We want to know what is the cash health in our business. And that's where the statement of cash flows is going to give us that. So for instance, right, we just talked about how...
Can I just jump in for a sec?
Yeah.
So if we look at, okay, so you've made sales as the top line, but you haven't received the cash yet from your accounts receivable. Is that kind of part of what we're saying here? Like, you're not going to have the cash in the business, but it shows that you do because you've made the sales. Is that?
And so the statement of cash flows is also going to break that down, right? So in the statement of cash flows, it isn't going to include cash not received. So there's two different ways of arriving at the statement of cash flows. We won't go too deep into this because it does get a little bit complicated, but there's the direct method or the indirect method. And either one of those methods is going to look only at the cash that is actually received from sales. So to that point, your P&L may show that you sold $60,000 and you've got $20,000 in profit, but maybe you've only collected $30,000. Now, where's the additional $10,000 that you need for payroll next week? So the statement of cash flows is another way that you start to arrive at, if I'm not factoring in my payables and my receivables, and I'm not factoring in, and I am factoring in paying myself as the owner, and I'm factoring in paying my debts, how much money do I really have? Right? So you'll see, and I am using financial statements just for clarity here. The P&L and the balance sheet that this breakdown is shown from is all happening in cash basis, right? So I'm not reporting accounts receivable in the sales here. If I was using an accrual basis report and this was showing, $20,000 in sales, my statement of cash flow would still back into what is actually been collected.
Okay, cool.
Okay.
Yeah. Thank you.
So you're welcome. So that's where the income statement shows up. Again, that's the top part of your statement of cash flows. Now, if we move down to the balance sheet, again, we're pulling the information from the balance sheet into that middle section of the statement of cash flows. And what that looks like here is that we had an increase in our liabilities of $36,41.50, and we also had a draw of $78,30.94. in the period, right? So the total money that went out in the form of owner's compensation, not through payroll, but through draws, minus the money that was infused into the company in the form of debt that was taken out, right, is this other cash items from financing activities, right? So if I had taken out a $20,000 loan here instead of credit card, it would be the same, right? This would show an increase in cash in the form of a loan and then a decrease in cash in the form of owner's draws, right? Does that make sense?
I think
On the
so.
balance sheet side?
Yeah, so financing activities, those are, what are financing activities?
So financing activities would be the movement of debt and liabilities and also the movement of equity.
Okay. Okay.
So in this case, there was an increase in liabilities and there was also an increase in equity distribution. So both of those have, so the draws, the owner's distributions have a negative impact on cash balances, right? That's money leaving the company. An increase in debt is putting money into the company in some form, whether it's using it on a credit card or taking out a loan and depositing that into your bank account. In either case, right, that's going to result in more money. So what this is saying is that the 783094 minus the 364150 is this other cash items from financing activities.
Okay.
So the result of these middle two sections, or these of the balance sheet, is what is going to give us this middle section of the statement of cash flows.
Okay. Okay.
So now to merge these two together a little bit. So now we've got net inflow from operating activities is 3773.46, right? The net overall outflow from the balance sheet is 4189.44. This is showing us a net cash flow of negative 415.98. So
Yeah.
$416 is the net overall outflow from the period, which if we look back at our balance sheet actually also matches our
Right.
change in assets.
Okay.
Right? So all of these numbers are kind of coming together to give us the cash flow statement.
Interesting. Okay.
So now we've got any other questions on this top part and then this middle part?
I don't think so. No, not at this point. No.
Okay, cool. So then, as I mentioned, this is sort of the summary, this bottom portion. So let me show you what I mean by that. If we go now into, this is again the balance sheet, but some of these numbers are also coming from where the income statement feeds into the balance sheet here. But if we look at this cash and cash equivalents, so this is saying the cash and cash equivalents at the beginning of the period was $2322.98. This is straight off of our balance sheet. If we look back here at our balance sheet, again, at the end of the previous period, that was our cash balance. And then we add in that net cash flows, which we just established was the total income minus that change from financing activities, right? That gave us that 416. So we take the cash at the beginning minus that change in cash flows. We get the cash and cash equivalents at the end of the period. So everything just kind of weaves together on this line of the statement of cash flows. Now, again, the reason why this is important is because we'll go back to that previous example. Let's say you did $60,000 of sales during the period and you spent $40,000. you're thinking, all right, I'm $20,000 up. Now, again, you need to factor in the $7,000 that you took out as an owner and the $6,000 you had to pay towards your debt.
Mhm.
The statement of cash flows is what is going to tell you that the net change in the period, even though you had $20,000 of profit, the net change in the period was only actually $7,000.
Hmm.
And that is the amount that you have to work with if you're making business decisions about what can I spend or invest? Can I take an extra distribution? Can I buy this piece of equipment? Et cetera, et cetera.
Okay. What are cash equivalents?
Cash and cash equivalents are going to be your actual cash on hand and also cash in various bank accounts. So that would be, if you've got 3 different checking accounts for different locations, or if you've got a checking account and a savings account, or if you've got a CD that you're saving at a higher interest rate, right? So cash and cash equivalents is actually your liquid cash.
Okay. Okay. What's the equivalent part though? I'm not sure. Is that like, would that be like a credit card, for example?
Nope, your credit card is going to be a liability. So a
Okay.
cash equivalent is going to be literally like liquid assets that you have in the company.
Okay.
So cryptocurrency, for instance, may be lumped under cash equivalents.
Okay. So, so are there any assets that are considered cash equivalents that we would see on the balance sheet other
So
than cash?
so you wouldn't see things like your fixed assets. One
Right.
of the things that happens when when the system is putting together a cash flow statement is that it also backs out any expenses and changes in assets that are related to your fixed assets. So for instance, depreciation would be excluded from the cash calculation.
Okay.
The statement of cash flows really is intended to measure specifically the movement of money through your business. So all of those other like non-cash, sort of intangible pieces of value that a business has, amortization, fixed assets, depreciation, all of that isn't going to be calculated on the statement of cash flows.
Okay. Okay. All right. Um,
Can I show you one more thing?
of course you can. Yeah.
So in addition to the statement of cash flows, some softwares offer even a more simple way of looking at this. And so in Xero, they call it their cash summary.
Mm-hmm.
And this basically takes everything that we just walked through. Now, this isn't available in every bit of software, right? And so that's why it's not treated as like one of the normal financial statements. But
Right.
if your software does have something like this, the cash summary will show you a simplified version of everything that we just talked about.
Oh, wow.
So
Okay.
it'll
That's
show you
cool.
here's all of the income,
Mm-hmm.
right? Same numbers we were just talking about.
Mm-hmm.
Here's all of your expenses. Again, the same numbers we were just talking about. And this refers to kind of like the cash surplus at the end of the period or your net income. So surplus here is the same as your net income.
Okay.
So then plus other cash activities. So this is going to say, because again, an increase in a liability is the equivalent of putting money into the business, right? This is increasing your available cash plus changes in equity. So this is a negative change in equity. So this is money going out of the business. So this, if we add these numbers together, we've got the surplus plus the other cash activity minus this change in equity gives us the net cash flow of that 416 that we saw on the cash flow statement. So then our summary at the bottom gives us that same information, our opening balance at the beginning of the period plus or minus the net cash flows gives us the closing balance. So in my work with clients, I
Yeah.
prefer to actually use this type of a report
Yeah.
because I think that this does make it a bit more clear where all of this gets lumped into this middle portion on a statement of cash flows, the cash summary really breaks it out so that you can see. And then also by default, this report also prints with your quarterly average. So how you compare throughout the year to other quarters, which
Okay.
can be very helpful if you're assessing
Yeah.
your overall cash performance.
Yeah, absolutely. Well, for me, that percentages make a lot of sense. What are some questions that you get when you're going over this with your clients?
Well, one of the biggest questions that I get, and that we may have touched on this a bit in the earlier conversations, but one of the very common questions I get is, what am I going to be taxed on if I take that money out of the business, right? So, like,
Right.
if I give myself a draw, what am I going to be taxed on? Where do I find that? And so, the place that I really am trying to guide clients to understand that what is taxable is your profit, not your changes in equity. Folks will often think, well, if I, don't take that draw until next year, my taxes will be lower. Your draws hit a different place. They are going to hit your changes in equity. So I encourage folks to look up here at this portion of the statement to
Hmm.
understand their tax liability
Hmm.
rather than looking down here.
Okay. All right. So are they talking about their tax liability as an individual, or are they talking about the business tax liability?
So they're usually talking about, they think that they're talking about the business tax liability. Since I work largely with S corps,
Right.
um, that is a flow through entity, so there is no corporate tax liability. It's entirely personal taxes. It flows through to their personal return.
Okay.
So often they think that they're asking, what is their business going to be taxed on, and the answer is they will be taxed on their profits.
Okay. Okay. But at what point triggers that? When they withdraw it out of the business, right?
No, what
No.
triggers the taxability is that it's recorded as profit up here.
Oh, okay.
So, so, and that is truly, I think, probably the biggest thing that seems to be misunderstood is that we think of draws as income, but we don't think about it as income until we take it. The truth is, in the IRS's mind, your profit is your income. Now, whether you leave that in your business bank account or take it home so that you can pay personal bills, the
Hmm.
profit is what creates taxability.
Okay. So we
So,
want to, yeah.
go ahead.
Well, I was just going to say, so we want to eliminate profit, more or less.
Well, it depends on that. That's you're talking to a profit first coach, and so
All right.
I have a
Sorry.
different I have a different view on it. I certainly, what I look to get my clients the best tax treatment that they can get
Mhm.
without putting their business into an unhealthy place. And spending your money because you've got it so that you can avoid some taxes isn't ultimately best for your company's sustainability and longevity.
Well, I guess it depends, right? I mean, it depends on what you're investing in. If you're investing in something that's going to have a larger return on that investment into the business as an asset, um, then that's probably a good thing, isn't it?
Sure. I mean, there are definitely investments to make in your business that are going to yield longer term profits, right? Um, that being said, there's somewhat of a mentality of constantly kicking the can down the road, like every,
That's where my head was going too. It's like someday you're going to have to pay.
right, exactly. And when that time does come, hopefully that comes without, before like an economic downturn takes you out of business, right? Because
Hmm.
ultimately, by spending all of your profits on business expenses, what you're not doing is creating a chunk of cash flow that's there when crap hits the fan. And for every business, there will come a point where sales are down, something happens in the economy, something happens with a supplier, something happens to the owner. Like there's always going to be something that is going to cause you to need a chunk of change. And if your business is used to operating on 95% of what you've got, so that
Mhm.
you don't ever have that much of a tax liability. And then suddenly your income drops by 40%.
Mhm.
Then what do you do with your company?
Yeah.
Then you take out a whole bunch of debt.
Mhm.
Then you've got this very small percentage of available cash to pay off the debt.
Yeah.
So it ends up really putting people in constantly chasing new revenue to keep up with ever increasing expenses.
Fair enough. And then if they're borrowing money, I would assume any banker would want to see profitability, wouldn't they?
Exactly. So one of the things that banks are looking at, they're looking at what is your overall profitability, but they're also looking at what is your liquid cash, right? So if you've got a ton of debt and very little cash assets, that doesn't look good from a bank, because the bank is thinking, well, are they going to pay me back?
Mhm.
And are they going to be able to pay me back with interest so that I make money on lending this money?
Yeah.
And if you don't have strong enough liquidity in your business, then you're less likely to be able to take out financing. So
Yeah.
again, when companies are showing profits and they're close to bankruptcy, part of what is often happening there is they've maxed out their borrowing capability. So much of their money is already going out the door to pay debt that nobody wants to give them any additional funding,
Mhm.
knowing that realistically they can't afford to pay back what they've got
Yeah.
now.
Yeah. Fair enough. The risk, eh, and it's expensive. If
Yes,
somebody's
exactly.
willing to loan you the money, it's expensive. Well, hey, thank you again. What else do we need to know?
I would welcome any questions that your listeners have on any of the videos. If you wanted to at any
Yeah.
point circle back and do well, can you explain this a bit more?
Maybe we could do, and we did talk about this last time,
Yeah,
is do a Q&A.
yeah,
And that would have to be like a live thing, I think, wouldn't it?
sure.
Or maybe like a LinkedIn Live or Twitter Space or something like that.
Something like that I would be absolutely available for. So
Okay.
a live
Okay.
Q&A. Also if folks want to send questions, directly to you if they can't be on the live call, so that you can get those questions answered by me, I'd be happy to do that too.
Absolutely, for sure. Thank you for
Yeah,
that.
of course.
Okay, well, I'll set that up. So, well, I'll set it up and see if there's interest and keep
Cool.
you posted, okay?
Perfect.
So anybody listening to this at the very end, please comment that you would like a Q&A, live Q&A with Stacey.
Yep.
Please and thanks. So
Yep. And if anybody wants to reach out to me, for guidance or questions or support in what you're doing with your business,
of
my
course.
website is the slcgroup.co.
Yeah,
And again, Stacey Bennett, I'm the lead profit advisor and accountant there. So
cool. Well, I'll put links to everything as I always
cool,
do. All right.
cool, cool.
All right. Thank you, Stacey.
Yeah, thank you.
You're welcome.
It's
Appreciate
been
it.
fun.
Okay, we'll
Yeah.
talk again. Bye-bye.
Bye.
Greg Sheldon here, your host of Metal, Steel, Manufacturing, and Business Pro podcast, where you learn everything about the metals and manufacturing industry that make your modern day life possible.